I present to you, ladies and gentlemen, Mo Hon Meng, co-founder of iFast Corporation and the moderator for this panel, Gavin Marriott, investment director with Schroders PLC and our keynote speaker, Prateek Oswal, head of passive investing at Motilal Oswal Asset Management, and Pyari Menon, Assistant Vice President and Institutional Portfolio Manager at Franklin Templeton India Asset Management Private Limited. Welcome all gentlemen, and over to you, Honmeng.
Okay, thank you, Dipali. Good evening, everyone. I'd like to thank my panel members whom Dipali has just introduced. Thank you for participating in this panel. Actually, a lot of the questions I prepared have already been addressed by Gavin and Pratik in your speeches, as well as the questions that followed. And I think just now with Derchin as well, some of the questions were asked. I think people are generally very worried about the bubble or rather valuations in the US, whether there's a bubble or not. So I guess I'm going to ask questions slightly differently, and I'm going to invite the audience to pose their questions. So I'll leave some time for questions, so that we can address a wider range of issues. Okay, the first question I have for the panelists is maybe a theoretical one. So if I forced you, if I told you that you could only invest 100% of your money for the next 10 years in either the US market or the Indian market, okay, completely all your money in the US or all your money in India, which would you choose and why? Let's start with Pratik.
Thanks. Yeah, thanks. That's a very interesting question. I do believe that it's important as a philosophy to invest in what you understand, and I think especially coming from my perspective, I think the Indian market is a lot closer to me. I understand the market a lot better. I understand the economics, the macro fundamentals, and also the sort of opportunity that exists in India today. So I would obviously choose India. I've always maintained that it's always really important to have global diversification, to have global themes in a portfolio. But for me, that's more of a diversification theme as opposed to an investment theme. So I would stick to India because of what I know about and because I'm right here.
All right. And so, Gavin, all your money in India as well?
Mm-hmm. Yeah. So much a theoretical question, actually, because personally I have exposure both to India directly and also the US, largely through global and thematic plays. If you were to ask me though which one I would choose, it probably would be 100% to the US market, and the reason for that is twofold. First of all, I think investing in the US, you get broad international exposure to multiple sources of revenue. So around 40% of the US index derives its revenues from the local economy, meaning 60% is derived internationally. And unlike India, where I think about 70% is derived from the local economy, that just gives me a more diversification within my portfolio. So I think that is primarily the reason. The second is you get a much broader spread of sector exposure, albeit there is a significant skew to tech.
Okay, thank you. And Pyari?
Yeah, so I think both the panelists have covered the primary things, but I'll just make one point with respect very specifically about the market, which is it is a developed market, but it has a lot of emerging market characteristics. And what I mean by that is, the growth rate which you see is slightly better than most of the developed markets. And the reason is a lot of trends. It's in technology, or whether it's in healthcare, even in consumer, actually originate there. So it's one of the markets where definitely should I think diversify, whether you're in India or wherever. So that's one of the huge benefits which I think investing in the US have. But look, end of the day, the theoretical question just, I mean, if you have covered all your liabilities and have significant extra already there in India, it would any spare beyond your next few years of liabilities, I would invest in you to get exposure to diversification. I think one of the benefits, which I mean, I'm just putting a simple number, is India is 1 billion people. But the per capita income of developed markets is 55 times ours. So, if an Indian, when he's got an opportunity, does the other markets, he's make huge mistake. That's the way I look at it.
Okay, thank you. So the second question really relates to this question about valuation that everybody's concerned with. But I thought another way to ask that question may be, what are you doing with your money? Are you right now adding to the US, or are you reducing from the US? Let's start with Gavin.
With my personal money or within our global portfolio?
With your personal money.
Oh, I'm very boring. My asset allocation doesn't change dramatically, so I'm just prepared to let my exposures run on the basis I'm taking a medium to long term view. So I clearly allocate more to the US than I do India, but that's simply because of an expectation on return. I think between two months. If I were to manage my personal portfolio tactically, I would probably be adding to the US despite valuation.
Okay, adding to the US, interesting. Let's go to Pierre. At this moment, would you be adding to the US or reducing from the US?
Yeah, I mean, no, I need to hold whatever I have for the simple reason. I think, I agree that, the stock bubble is gaining steam, but it's something that's been going on over the last 10, 11 years. I mean, even in 2009, market fast. And so long as there are enough players, I think we are in a reasonable kind of safe territory. It's not to say that the signs of a bubble, but I was reading a McKinsey piece that they had put, which used a very they called it the rational bubble. And genuinely around the world, it is. I mean, there is be pockets of business that is happening. There'll be some hot stocks, and you just can't do anything about it. But if you look at it, the market has been very odd. And stocks that have done very well have been sectors and the stocks which have, blown the earnings out. And if you look even in geographies, I think one of the things, I know it is a US discussion, Europe is still not beyond the 2000 peaks. So for the last 10 years, the market has just not moved in Europe. So the market allocation, and these days the liquidity that is being pumped in basically just finds its way to wherever it wants to go. So the market has been very discerning in a kind of pushing up these things. I agree there are enough kind of when the liquidity rises up, there will be a problem. The way I look at it is, despite the valuations being so high and yields now going up, I think the tiebreaker is, are we in a bull market or not? And as that is my bias. I think we are in a bull market. There are some signs of, but it is, and there are some. I mean, as you will have always some eye-popping stories about huge run-ups, but I still think that a lot of movement of the major stocks have been actually for legitimate reasons. Yeah, just not an accident. That's the look at the market as it is now.
Right. So, Pratik, your personal money, are you adding or reducing from the US?
Yeah, so I've been adding for some time now. So I think unfortunately, I think me as well as I think most of the investors in India are heavily underpenetrated towards I would say global equities. So I think I would, and I'm still recommending, I would say, investors to add on to their portfolios. The only difference I would do is to not really do a huge lump sum. I think I think dollar cost averaging can really help out in a very big way, because it really minimizes any volatility that comes with any investing. So even if you started, say, doing a dollar cost averaging at the peak of the tech bubble or the peak of the housing bubble, I think you should be fine because of it really averages out your sort of performance over time. So I think it's important because as a country, most investors are thoroughly underpenetrated towards their ideal asset allocation. So I do believe that you should ideally add on to to your US book, but obviously I think I would also recommend it doing slowly, which is what I've been doing.
Okay. Well, there you have it, ladies and gentlemen. All three of our panelists would be adding to the US rather than reducing. So I think that's an interesting answer to whether they think there is a bubble in the US or not. I think they clearly think that there are still opportunities, and it's not a time to be avoiding it altogether. Okay, let's go on to the next question. And this has to do with this famous debate on whether active is better or passive is better. So, I mean, with valuations being stretched, if you invest passively in, say, the S&P 500 index, you can't, you can't do anything, right? Currently, I think you have Tesla at number 6. I mean, it's the sixth largest, stock in the S&P 500. It has a higher weightage than Berkshire Hathaway. So, but then if you bought S&P 500, you have no choice, right? You just have to buy into the proportion, the weightage that's there. So some say it's a good time to be buying actively managed funds because the fund managers can then choose stocks that are better value or stocks that are poised to recover even better after COVID. What are the panelists' opinion in terms of whether it's at this current moment, active is better or passive? Whether active has a bigger role to play than passive. Let's start with Pierre.
Yeah. So the word which I think you're talking about is the passives will be forced to own stocks which seem to be overvalued, irrespective of whether the portfolio manager wants it or not. But I mean, the way the passives was every day, whatever inflow or outflow they have, they keep rebalancing what their position is. And so that is one of the things that they automatically do. So it's not going to be that big over a period of time that's going to happen. And if on average, whether it's a down year or an up year, roughly somewhere between 20 to 35% managers beat the passives. But otherwise, the passives, most of the passives outperform more managers. That is 20 to 35% of active kind of mentioned. Very few do it on a consistent basis, but there are some who do reasonably consistent. If you can find them, I think you should go for the active manager. But the next point is, the advantages actives may have is most of us keep some cash on the side for a rainy day or for redemptions, which I think most of us don't. But that's a small amount. Typically, it's about 5%. Even a decent move, it's not going to have such an impact. But I think to get to I think one of the things in terms of valuations which have looked at it just in terms of how much money flow has been getting allocated. So roughly for it, so if I look at S&P and if I look at NASDAQ, for every dollar over the last 10 years, 20 cents went to the FANGs, the top five names. I wouldn't say just FANGs, but Microsoft. So depending on which, is roughly about 20 plus cents went. And to the NASDAQ passive, almost 40 cents. So that was driving up the momentum. So now I think FANGs plus Microsoft it might be 22, 23 kind of percentage. So when that goes out, is basically what the is, and small percentages there exaggerated impact. At the same time, I think if I look at the top 5 2020 top holdings, there have been names which have gone out passives because they dropped out and somebody else was setting the price. But the passives have still done very well. So you don't have Chevron, you don't have Exxon, and I think GE was another one. All of these are out of the top 5. but passives are still formed. So I think it is a case of trying to figure out which fund manager you want to invest in if you're good with active. But people, I think the passives do okay if you, even in this kind of situation. I think it will still continue to remain this 30% of the people beating the market. But yeah, I think passive is a good way to kind of save on some fees, which over will pay you off. I don't know if I answered the question. That's basically the way I would kind of look at it.
Yeah, yes, I think you did. So let's go over to Pratik.
I do have
Oh. Sorry, there was a bit of a lag. Yeah, well, let's go over to Pratik.
Okay. Yeah. So it's it's I think the way I see it, obviously, I mean, I might be biased towards passives because we are as an EMC selling passive funds in India. But essentially, what we've seen is that obviously the debate between passive and active has been quite, I think, heating up in India as well. But it's pretty much still 50-50. But when you look at the more developed markets such as the US or maybe Europe or even other markets, I think you do see that over a long enough time span, you do see significant amount of outperformance in most of these passive funds. So essentially, I think yes, in the order of simplicity, if someone does not have the bandwidth to go out there and select the right funds in their portfolio or right active funds, then I think passive funds make it super easy for you to invest in and also get equity exposure in general. I also feel that for someone who's looking at it from a very long-term perspective, say for example, the S&P 500 has been around for almost half a century, and not only has it really thrived, but it's actually I think managed to survive over that entire lifespan. So I do think that people who are looking at a decision when it comes to say just diversification, then you could keep it super simple and just invest in an S&P 500. Or if you want a higher allocation towards the techs, then you can obviously go to Nasdaq. Or I mean, there's tons of options. Even if you think that you are obviously do not want to be top heavy, you always have themes such as small cap value or a small cap index where you can obviously play around with the rest of the sort of equity landscape. So I do feel that for simplicity purposes, I do feel that passive works out really well. But if there are investors who are looking at alternative themes, so for example, disruptive theme is or disruptive innovation has now become a big theme on the back of really good performance over some of these technology indices. So yes, if there are investors who are taking a bet on certain themes or certain strategies, then I would say that active obviously makes a lot more sense, or they could sort of add it as one of the funds in their active portfolio. But overall, I think to keep it simple for someone selling in India, I think it's a very simple thing to go for like a simple index fund that's giving you exposure in broader markets.
Okay, thanks. Gavin?
I'm probably going to surprise you and agree actually that there is definitely a role for passive management. I use passive exposure within my personal portfolio, particularly where I'm just looking to maybe add tactical exposure to an area of the market or a region on a short-term basis, and I'm going to trade that. So I think there passive has a role because it's a cheap way of obtaining market beta. In the context of longer-term allocation, I think there is again a role for both. I clearly would favour active management, and I don't think that decision changes by geography. So many people would argue that the US is a very efficient market, and therefore active management can't add value. I sort of would push back on that because the inefficiency in the market, in the US market, is as strong today as at any time in the past 30 years, in my opinion. The market will overreact to short-term data. It fails to look far enough ahead in terms of understanding some of these themes. And if you have an active manager, I think you can do very well. So horse for courses, but I think in the context of US equities on a long-term basis, playing some of the themes and being sensitive to some of the valuation excesses at the moment, I would definitely take an active.
Oh, interesting. So both Pratik and Gavin said that you could use passives for this tactical investments in the US. So could you share one idea that you are currently invested in or looking to invest in? One tactical idea that you like. Let's go. Let's start with Gavin.
Thanks. Well, the way I'm using passive at the moment in my personal portfolio is to increase my exposure to European equities, and I do that via a Vanguard ETF, and that simply reflects a positive view about global economic recovery. Europe is, much more heavily orientated to that cyclical recovery, and I just want to add a bit more exposure in that particular area. So that's something that I've done in recent months, an example of how I use passive.
Okay, Pratik.
Yes. So,
sorry, Pratik. Just before you answer, maybe I just prepared the audience. Just after Pratik's answer, we'll be taking a couple of questions from the audience. So do send in your questions. Thanks. Okay, over to you, Pratik.
Yeah, thanks. I would also sort of have a very similar answer to what Gavin had. Essentially, I think a lot of people are just talking about the US and the US only, but we're looking at a broad recovery. We should also be looking at Europe. We should look at markets in the EU and as well as Japan, as well as emerging markets like China, Taiwan, Brazil, Korea. So I do feel that I think investors today are. I remember in 2008 when I was in college, when everybody was just like investing in emerging markets and nothing else. And today it's the exact opposite scenario. So I do feel that I think everyone who's looking at investing should ideally have a more broad-based approach towards investing, and should also be looking at like the EU, Japan, and also emerging markets, which I do feel is going to have an incredible recovery this decade, because last decade was not really that great.
So sorry. So your one tactical idea is?
I would say like a if I had to choose, I would do an emerging market strategy.
Right. Yeah. Right. Yeah. Okay. Cool. Okay. Let's go to some audience questions. Okay. The Chinese are trying to push the West with their own protocols changes to technological standards. How will the world evolve out of the biggest tech battle of the century between these two countries, and how will it impact investors? Any of you have a strong view on China? Maybe I start with you, Gavin, since you're a global manager.
It's a very relevant question, and that's surprising actually is the amount of exposure to tech-related industries you get through an investment in China. I mean, in the US, if you looked at tech-related businesses, the IT sector plus any tech-related industries, you probably have around 35 to 40% exposure to that area within a US index. In China, you're probably pushing 30% already today, and clearly there is a strong focus in terms of innovation in that country. So I think from an investment perspective, it's just to be aware that there is another game in town. It's not just a focus on the established US tech providers that have dominated the market for many years. The emerging technology providers in China, I think now are very credible alternatives. It introduces a whole raft of additional competition, and it will have implications in terms of the margins and the financial characteristics of the tech industry more generally. It introduces healthy competition and some disruptive competition as well.
So what should an investor do?
Well, I think again, it's just to be aware of companies' competitive moats, the extent to which proprietary technologies can be maintained, and to what extent there is the potential for competitive risk that could disrupt the growth that you're modelling into your to your financial models. We look at some of the established tech players today, and we look at the valuations, which are in many respects assuming that competitive advantage, current margins can be sustained for 25, 30, 35 years. And in tech fast-moving pace, it's unrealistic to think that a company can sustain that level of advantage and pricing advantage over a 15, 20-year time horizon.
Okay. I'm just going to direct one question to each of you, unless you feel very passionate about the questions. So just speak up if you do. Let's go to the next question. Economic divide is poised to significantly widen further in India. What do you think the Indian law policy makers do differently to accommodate equitable growth going forward? Okay, so I'm going to direct this to Pratik, who has all his money in India. No, no, not all. I mean, in that theoretical question, but to you, Pratik.
Yeah, I think it's a very important question because, if you look at India today, it's a lot more, I would say, divided in terms of the economic landscape than what it used to be, say, 10, 15 years ago. But I also think that, in India, unlike other markets, more developed markets, there is some bit of, trickle-down effect that you see in India. And you've seen that over the last 20, 30 years that, you have seen, a lot of the the upcoming middle class, which has now become a huge part of India. So I do feel that, India is now sort of, I think a lot of India is still sort of, not really evolved in the last 10, maybe last 20 years, but I would say a good proportion of it is sort of, I would say middle and upper middle. So I do feel that, yes, the divide is still there, but it has, I would say not as steep as what it used to be a few decades ago. And I do feel that the government is, pushing its agenda. I do feel that, education itself is a huge requirement in India, and that's already pushed a lot of people out of poverty in India. And if you look at the statistics of poverty in India versus what it used to be, it's a lot lower than it's there. So I think number one, I think a lot of entrepreneurship in India is going to, really help build newer companies, which will obviously expand, I would say, the entire sort of population in terms of employment. The second is, and this is the most important point, is the average age. India is a pretty young country, so obviously, and the gross productivity of India will increase a lot more as these people leave colleges and go and, I would say, work in companies. So I think a big challenge today, the way I see it is, how do we employ these millions of people who are coming out from Indian colleges on a yearly basis? So that is going to be a huge challenge, and if the government's is managing to ensure that employment is low and these hundreds of millions of people who are coming out of colleges and are getting good roles, then you can expect a lot more equitable India going forward.
Okay, good. So let's do one last question and then we can wrap. Is it good to invest in crypto shares like MSTR? Well, Pierre, you got that question. You give it a shot. Pierre?
Hello?
Yeah. Okay, I can hear you now.
Yeah, okay, sorry. So, I don't have any cryptocurrency positions at all. And for the simple reason, I think it goes back to what Pratik first said. I've just not figured out, what it really means. It's not a currency because it's not very liquid. I cannot do any transactions. It's not an asset in the sense it creates any cash flows for me. It doesn't even have the value like an artwork or something will have. So I just can't figure out what it really is. The benefits of this is, either way I look at, the only reason I kind of noticed is something called the Harry Potter effect, where Potter books started to have strong sales. Books also started to have strong sales because people went to the shops to buy. And whenever the cryptocurrencies have been having a run, I think what you see in the markets also I don't think there's some kind of a hedge on the markets because it has been pretty driven. So it is just you're going along for the ride. So recently you've banks talk about it, and you've seen even I think Janet Yellen talking about it recently. So I just can't make sense of it. At some stage, maybe this will become something that is very, very important. But I don't know how to play it. But there have been companies, which have made a lot of money. Regular companies, to give examples, we're talking, not mistaken, Taiwan company TSI and these kind of people, because Nvidia claims about almost 7-8 of their, the graphics chips that is actually going into mining for these things. So there is ecosystem being formed around it, and I'm sure that there will be, they'll be there in some form or the other 5, 10, 20 years down the line. But I just haven't got my head around it.
Okay, quick yes or no question. Pratik, got cryptocurrency of any kind?
Sorry, could you repeat that, please?
Quick yes or no question. Do you have crypto of any kind?
I do.
Okay, Gavin, do you have yes or no?
No, but I think I probably will have in 5 years' time.
Oh, no? Okay, interesting. Piari doesn't have. Pratik has. And Gavin, no, but he will probably be buying soon. So that's something that I'll leave the audience with. I'm told there are over 650 audience members at this time. So 600 people thanking you guys for all your answers. I hope it's been insightful to all the audience members. Thank you. Back to you, Dipali.
Thank you so much, gentlemen, for such an interesting conversation. You guys are certainly having fun, and the energy showed. Thank you again for joining us.